There's a rich investor that goes by the name of Warren Buffett. You may have heard of him. He years ago actually made a $1 million wager that the simple method that we're discussing here today in this video outperforms any hand-picked portfolio of stocks over a 10-year period. So on one hand, you have a very simple strategy, and then on the other, you have a far more complex analysis-driven strategies led by many different professionals, but can you ultimately guess which of them outperformed each other in the 10-year period? That said, your greatest superpower as an investor is Hey everyone, I'm going to teach you step by step how I invest and how to avoid a lot of the investing mistakes I see being made day after day. Now, disclaimer, I am not a licensed professional and this is not official financial advice, so do not sue me. With that said, let's jump straight into the content. Now, I personally invest with Vanguard and I highly recommend it to anyone who's beginning their investment journey to use that tool as well. There's a number of reasons, but without going into too much detail, I'll certainly say that first off, they're a very reputable platform to use for investing. And second, for the way that we're going to be investing, they certainly have a lot of the lowest fees. I know a number of folks who use Fidelity as well, and they're great too. I'll say that in some ways they're even better than Vanguard, but for our purposes, again, they're not going to make too much of a difference. So if you have either or, just stick with that tool, meaning if you already have Vanguard, just stick with Vanguard. If you already have Fidelity, just stick with Fidelity. If you have neither, I strongly recommend just going the Vanguard route. Plus, it'll be a little bit easier as I'll be explaining Vanguard, so you can just mirror my method as well. Now, if you're new to Vanguard, I do recommend going to their website and opening two specific accounts. Now, the first is going to be a taxable brokerage account, and the second is going to be a Roth IRA. Now, the Roth IRA is only eligible to folks who are within the income limit for the year. So to all the ballers out there that are earning above the eligibility income limit for a Roth IRA, I do recommend you go ahead and open a traditional IRA in its place. That said, a Roth IRA is a little bit more beneficial, in my opinion, than a traditional IRA, but I'll be going into more detail about that a little later, along with more details on the tax benefits and rules when it comes to a lot of these different retirement/tax advantaged accounts. For our purposes today, it's important to note that these tax advantaged accounts, such as a Roth IRA, traditional IRA, or even a 401k, is that they provide tax benefits to us, but the expectation is that you're not going to be withdrawing on these accounts until you're at least 59 and a half if you want to avoid penalties. Now, there are some exceptions that I'll explain later in another video, but I always recommend that any money that you put into these accounts, don't plan on touching it until you're at least 59 and a half. All right, now time out. Let's talk investment strategy because you can make a lot of money investing if you do it the right way, but if you do it the wrong way, I can assure you you'll lose a lot of money too. Everyone needs to understand that investing is simple, but investments need time to grow. Folks who are trying to make money in the short term with the stock market are referred to as traders, and we're investors. As far as I'm concerned, trading is quite literally the same as going to a casino and gambling. So you may win a couple of times, but I can assure you in the long term, that's not gonna be the case, especially for those folks out there that are day trading with crypto. Now, my 2 cents as an investor is that you not put any amount of money into the stock market that you see yourself needing in the near term. Now, by near term, I mean anything within the next 10 years. Put simply, the stock market only goes up over the long periods of time. And you can see that from the 100+ years that the stock market has been running, that it is only going upwards. But that said, it does tend to take a dip from time to time. So in the short term, it's quite possible that your investments will decline in value. And trust me, Take this from me, from having experience, it will suck to see your investments decline in value, but the thing is, you still have to hold through it. Now, everyone has to take a chill pill because over time, the value of our investments will recover and continue to grow. Now, I'll explain more about the mechanics behind this in another video, but just understand, think about like all the scariest things you've probably heard in the past about the stock market, like the Great Depression or the 07, 08 recession, where we thought that like, oh no, the stock market's gonna crash, it's never gonna recover, things of the sort. I can assure you that the stock market today is far higher than either of those 2 points, and it will only continue to grow, just judging from what we've seen over the last 100 plus years. Now, I can't promise you that any money that you put into the stock market today will be worth more tomorrow or next week or even next year, but with good confidence, I can say that that money will be worth more in 5 years, and with great confidence say that it will be worth more in 10 years, and with even greater confidence say that that money will be worth even more in 20 years. So again, we're thinking about the long term here. Now, over the last century, the annualized rate of return of the US stock market has been 11%, and adjusting for 3% inflation, that's roughly 8% of real returns. So again, I'm not gonna try to get too complicated with this video, but an 8% return is what we're generally going to make assumptions with of how much growth we're to expect on our investments when looking at the long term. So as a quick demonstration, if in case you invest $500 a month for the next 35 years, and we still assume that 8% annual growth, you will have $1 million in your account by the end. So just to explain, you will have only contributed $210,000 in that 35-year period, but due to the stock market doing what it's been doing thus far for the last century, will ultimately 5x your money. So the other 800,000 will ultimately have been growth from the stock market. So hopefully you're beginning to see how powerful investing is and how much it can really multiply your money over the years. Now, I understand not everyone has $500 a month over a 35-year period to contribute to investments, but the example I'm giving you right there is if in case you are maxing out your Roth IRA each year for the next 35 years. Now, I'm actually basing this off of the numbers of the contribution limit that was a few years back when I originally started, which was, I believe, $6,000. But over time, I believe today now, the contribution limit has increased to now $7,000. So again, trying your best to reach that contribution limit each year while you're eligible for a Roth IRA will set you up to be a millionaire when you retire. Now, because you contributed into a Roth IRA, when you're at least 59 and a half and you do decide to withdraw on it, that's all your money. That's not a single dime is owed to Uncle Sam. So you don't have to worry about like a 25% federal tax cut that might have to come out of it. It's all yours. So if your Roth IRA reads $1 million, you have quite literally $1 million that will be untaxed. So it's a pretty good deal to have a Roth IRA. All right, now let's pivot back over to Vanguard and discuss what we want to invest into. So now that you have your accounts created with Vanguard, the hard part's over. It's now just a simple process of repeatedly investing in a single asset. Again, it's not anything crazy. You're just investing in a single asset over time and watching the value of that asset grow. The single asset I'm referring to is a low-cost index fund. Now, I'll break that down for you. A low cost, meaning that the expense ratio or the amount they charge you per year to own that asset is low. In my books, I consider a low expense ratio to be anything less than 0.1%. Now, this is how much that they will be taking from the amount that you have invested. So say, for example, if you have 0.1% of $1 million, that will be $1,000 per year that they'll be taking in order for you to own that asset. Next, an index fund is shares of different stocks of different companies bundled together to be sold as one. And the point of an index fund is to mirror the respective index tracker, market index tracker that coordinates with it. So perhaps you probably know like the S&P 500 or the Dow. These index funds are made to mirror those specific indexes. So there are index funds that say mirror like the S&P 500 and actually allow investors to invest in those specific indexes. Now, my favorite index to keep an eye out for is the S&P 500, as it's the 500 largest US publicly traded companies at that given moment. And it serves as a good proxy for how the health of the US stock market is. Now, the index fund that we want to buy in Vanguard is the VTSAX. That's the acronym for the Vanguard Total Stock Market Index Fund, and it's the fund or asset that I invest in personally. I can make an entire video explaining why this asset is great, but just to cover the highlights of it, I'll say that the expense ratio is a low 0.04%, meaning if in case you have $100,000 invested into this particular asset, you're only going to be charged $40 a year to hold that fund, which is insanely low considering how much it will be earning for us over the years. Additionally, the way that this fund is set up is that it holds a fraction of every single US publicly traded company, making it heavily diversified and quite literally representing the US stock market in one single asset. Now, if the US stock market continues to grow as it has over the last 100+ years, owning this asset will allow us to capture that value. Now, that said, in order to own this specific asset, there is a minimum investment amount of $3,000. But if in case you can't meet that $3,000 threshold, I do recommend opting for the ETF version of it, which has the acronym VTI. For our purposes, it operates very similarly and quite literally is almost the same. But if you can't meet that $3,000 threshold, go ahead and opt for the ETF version. But if you can meet the $3,000 threshold, just go ahead and invest in VTSAX. Now, for the folks that have Fidelity, I recommend the Fidelity Total Market Index Fund, which has the acronym FSKAX. It's quite literally the same as VTSAX and actually has some benefits of its own, such as it has a no minimum investment amount, so you don't have to worry about that $3,000 minimum investment amount with VTSAX, and also surprisingly has a lower expense ratio. So again, more savings down the road when you start investing a lot more money in there. But that's literally it. You just want to continue to invest in that single index fund and watch your money grow. I will say, if in case you have a Roth IRA, I do recommend maxing that out first, meaning buying your shares in your Roth IRA account until it's maxed out. And then assuming you still have funds available to buy more shares, I do recommend then investing in your taxable brokerage account. Now, later on, I'll be making additional videos that will cover the strategic approach to which order of accounts you want to invest in to hopefully get the best bang for your buck in terms of tax benefits. And then also the ways that we can improve our portfolio by adding bonds if in case you're nearing retirement and do want to take a less risk aggressive approach towards investing. This video alone can help you become a millionaire sooner than you think and reach financial independence if in case that's your goal. That said, your greatest superpower as an investor is time. And with it, you will be able to maximize your wealth. So I do suggest trying to invest as soon as you can, because time in the market is what will ultimately help you become rich versus trying to time the market. And with investing, you do want to make it as simple as possible. So I do suggest taking advantage of some of the tools that Vanguard has to offer, such as the auto invest function. So say, for example, if you know that you have $100 a month that you can spare towards investing, I highly recommend setting up that auto pay system so that it withdraws that $100 from your account every month and puts it towards investing in buying those shares. Because over time, you'll be surprised how much it'll grow without you having to think about it. All right, and until the next video, spend less than you make, invest a surplus, and avoid debt. Peace.